Good evening. Thank you for joining us tonight. My name is Sheena Pasco. I'm the Director of Marketing for the Startup Path. Welcome to the Startup Path webinar. Tonight's topic is raising equity capital. We're pleased to offer these free webinars because we believe entrepreneurs are the drivers of wealth creation around the world. Before I introduce our guest speaker, I would like to tell you a little bit more about the resources we have for you at the Startup Path. Step 1 features our free webinars, where you will learn the basics of starting your own business. Step 2 provides you with assessment tools to help you find the right fit between who you are and the wide variety of business opportunities that exist. Finding the right fit between your personality and the type of business you start is crucial to your success. Step 3 enables you to learn a business from a mentor. We currently have 25 mentors online who reveal their tips, techniques, and secrets to success in a wide range of industries. We have packaged each mentor's journey and advice into a talk show format we call the Startup Experience. Steps 4 through 6, contain 21 online lessons that cover everything you need to know about starting, growing, and running your own business. The featured speaker in today's webinar is the Startup Path's resident expert in entrepreneurship, Dr. Tom Duening. Dr. Duening is the director of the Center for Entrepreneurship at the University of Colorado in Colorado Springs. He has been an entrepreneur since 1984 and has started and ran several businesses in his career. Dr. Duening has also written 12 books on business and entrepreneurship and has consulted with startups in all different industries. Please be aware you may see the waiting room screen come up again as we transition into Dr. Duening's presentation. It is my pleasure to introduce to you Dr. Tom Duening.
Thanks, Sheena. Well, welcome everybody. Tonight we're going to be talking about the issue, I guess, that every entrepreneur thinks about, and that is, where is the money? It's like that old, I think it was Wendy's commercial years ago, where's the beef, right? So where's the money? And of course, every entrepreneur finds themselves to be cash strapped from time to time, and there are a lot of different relationships that you can use to sort of manage some of the issues that come up with operating a company. But before you're operational, you have to be able to raise some money too, oftentimes, and that's where a lot of entrepreneurs simply get into trouble. So I thought it would be useful to have a webinar that would address some of the different sources of capital for mostly any type of entrepreneurial venture. Certainly there are certain types of ventures at any given time that are more favorable to the environment. We had a run of companies back in the late 1990s, early 2000s, the famous dot-com revolution. These companies were able to raise money with a couple of PowerPoint slides and a good story. You know, that kind of went into the past. Technology is still favored. It's still something that a lot of different people with money and want to invest in, but there's a lot of ways for you to raise money with any type of venture that you might have, and we're going to just discuss some of those different avenues for raising capital here tonight. So let me begin by getting into sort of the role of capital in new ventures. And the only reason that I really want to highlight this slide is that it's kind of counterintuitive perhaps for a lot of people to think about, but it is possible to be overcapitalized. And you think, how is it possible that I might have too much money in my venture? And in the early days, you know, when your venture is just getting off the ground, it's just incredibly important to develop the kinds of money-saving disciplines and you know, internal systems and processes that will lead to effectiveness and efficiency over the long run. So a lot of times entrepreneurs go into the marketplace without any real good idea of what type of money, what size of a round of a raise they need to do, and how much money they need to raise. And what ends up happening sometimes is they're overcapitalized. And then when they have too much money at the beginning, they don't put in place the systems that would be necessary during the lean times. So it's very important for you to really think very, very hard about how much money you actually need to get to a point where you begin to flow enough cash in your company that either you're going to be able to sustain yourself by internal cash flow management and maybe a banking relationship to supplement that without having to go to the markets to raise some more equity capital. So capital raising is something that is done throughout the lifetime of a company, and I think this graphic here perhaps captures that pretty well. If you go down to the lower left-hand corner down there, near the startuppath.com logo, you'll see that you're in the concept stage of your company. And at this time, guess what? The only money that's available is the money that comes out of your own pocket. Or perhaps, we say FF and F, friends, family, and fools may be available to provide you with a little bit of capital at this stage. The next stage of your company is something we call the seed stage, and this is where you're in maybe prototype development if you have a product, or maybe you are testing your service offering with some potential clients and so on, and maybe even doing some pro bono work. And pro bono means free, just to get some experience, to get some testimonials, to get some idea of whether or not your service actually works. And believe me, in the various companies that I've had throughout my life, I've done a lot of free work just to demonstrate to people what it is that we're capable of doing. And so don't be afraid to do that in the early days. I know that you're not, bringing in the money that you need, and certainly you don't want to give the impression to people that what you're doing is free. But you might have some type of a very, very low fee or something just to get your foot in the door, get some testimonials, and begin to iron out the kinks in the various services or products that you're going to be offering to the marketplace. When you finally launch on startup, well, that's when your pricing needs to be in place, and you can have some discount pricing, but you need to know where you want to begin to price your products and services, because eventually you're going to have to be able to break even just with your sales, right? In order to grow a venture, you have to get to a point where you can show that, in fact, by virtue of selling the products and services that you've created, you're able to meet all your obligations in the way of expenses and other things. Typically, there's not much capital available to a startup venture, because this is where you're really proving out your concept. You're proving that the market is ready, willing, and able to pay for what you've done and what you've created and what you're bringing to the market. And most sophisticated investors have been through this many times before, and they know startups have a real tendency to fail. And even though you have some great entrepreneurs and some great ideas, oftentimes these ideas are ahead of their time, or just not right for the current environment or whatever. So most investors that have any sophistication at all are very skeptical about a startup. And one of the things that is going to be very difficult, and is a concept that you should remember, is that if you are pre-revenue, and that means you simply have not made any sales yet, you are pre-revenue, it's almost impossible to raise any outside capital. So you want to get to revenue as fast as you can, and that's why I say early on you may want to create some very steep discounts just to get those early adopters on board, let them begin to talk about your company, because investors get a lot more interested when they see that you actually have clients that are willing to pay for what you've created and that you have some revenue. Even though it's not great revenue, the point is you have to look like you're able to grow with the capital that would be invested into your deal. The first stage now is when you're starting to get a little bit more serious, and this is where you in fact have begun to experience some customers that are actually willing to pay full price for what you're doing. You might even have developed some recurring revenue by now, where customers are coming back and buying more from you. And it would appear, based upon what's happening in your marketplace and with your products and services, that the only impediment to growth is capital. And when that's the case, you have a really strong position to raise money from angel investors, venture capitalists, and others. And then, of course, at this round, typically it's a smaller round of investment. It's not going to be the big stage that's going to get you to some type of an exit. But so, and your valuation is not high enough yet that would justify a major investment. So you're just trying to prove to people that when they provide you with the capital to grow, that in fact you're going to use that money in a wise and in a wise manner to execute your plan and to actually create more value in your company over a period of time. If that's the case, if we throw in a little bit of money as investors into your company and you demonstrate to us that you use that money to grow and expand your business, well, then bigger money comes available to you in second stage and so on. And eventually you get to the end of the game there, where you get to an initial public offering or a sale of your company. So remember, capital raising is usually done in multiple rounds for most ventures. And depending upon where you are in your maturity of your venture, different types of capital will be available to you. If you look down here on the seed stage, for example, as I mentioned, it's only going to be friends, family, and fools. You might have heard of things like angel investors, and you may have heard of venture capitalists. I can guarantee you that none of them will be available to you at this stage of financing. Maybe some angels would be available at startup. VCs begin to get interested in the first and second stage, and even here on what's called a bridge loan or a bridge round of financing is typically done simply to get you to this stage here of an exit. So know the right types of investors or lenders that would be available to you depending upon the maturity of your venture, and don't try to kid yourself about where you are because you simply will not get it past a sophisticated investor. So, you know, one of the things I constantly tell my students in my classroom that I'm teaching the principles of entrepreneurship this semester is always face reality. Don't ever try to make reality better than it is. By facing reality, you'll know exactly what you're up against, and you will certainly earn the credibility of those in the industry who are providing different types of loans or investing, that you, in fact, understand exactly where you are in the development of your company. So equity financing is kind of interesting financing. It's what we call investing capital, investor capital, and it comes from individuals or institutions. And of course, the individuals we mentioned are friends, family, and fools, as well as angel investors, and the institutional investors are the big venture capital firms. And unless you have, you know, the potential to grow into a $100 million company, you simply don't want to even get interested in venture capital because it's not going to happen. There are some alternative venture capital financing options that have recently become available, and I will mention those, but typically they have a lot of caveats associated with them, and you're going to be very careful about assessing whether or not they're right for you. So you certainly want to find, if you're going to go out for equity financing, you want to find individuals that can invest in your company that in fact can add more value than just the capital. You want people that are savvy in your industry. You want people who can open some doors in your industry, some people that can maybe sit on your board and give you additional credibility and things like that. So equity financing is a very serious game to some extent. It's a fun game. I've played it many times and been successful many times and unsuccessful on other occasions in raising the money that we need to grow our company. The terms of your investor opportunity typically are specified in a very technical document that's called a private placement memorandum, or PPM. Any attorney that works with small businesses will know exactly what this is and will have some idea of what kinds of terms to place into your private placement memorandum. So when you make an offer to the investor community to invest in your deal, the terms of that offer are specified in detail in the document that's called the PPM. Now the PPM differs from your business plan in the following. The private placement memorandum is a required document from the Securities and Exchange Commission of the United States. Right? It's a federal government body that governs all equity transactions in the United States. So therefore it has to demonstrate, it has to clearly articulate all of the risks that are associated with investing in your venture, including a substantial risk of loss of all invested capital. I mean, your PPM is going to tell people, you know, stay away from this, don't invest. You know, in a sense, it will say, be very careful, as opposed to your business plan, which is a promotional document. So remember, the PPM is a document that specifies all the risks that are associated with investing, and typically this is embodied in some boilerplate. If you get a PPM template from your attorney, most of the risk language will be in there already, and maybe then just modify it a little bit for your own particular industry and your own particular company. But your business plan does not need to be as careful as your PPM because it is not a document that is governed by the SEC. It is a promotional document. So your business plan should be promotional as hell and should try to get people very excited about investing, and then you hand them PPM, and of course most sophisticated investors have seen many PPMs, and they're not going to be fazed by all the risk language that is associated with that. So equity financing is kind of neat because it does not require repayment. Of course, people expect to be repaid when they invest. They expect to be repaid with a premium, but there is no requirement. In fact, and that's why the private placement memorandum specifies that there's a substantial risk of loss of the entire investment. So anybody that invests in a small startup venture on an equity basis knows that their money's at risk. Of course, what they're hoping for is that this venture is going to grow into something gargantuan and their money is going to be multiplied many times over. Investors in private equity deals must be what is called accredited. And that means if somebody is going to write you a check and take an equity position in your company, they must be, in the eyes of the SEC, what's called an accredited or qualified investor. And the SEC defines that by the following. They say that an accredited investor is an individual that has $1 million of personal net worth or has made at least $200,000 a year of income in the last couple of years and has a reasonable expectation of doing so in the current year. And here's why that rule is in place, because there was some scandals at the turn of the 20th century where people were investing in things that they didn't know anything about and they got wiped out. And so in order for you to make an offering of stock to private investors, the SEC says if they specify to you that in fact they are accredited, according to the definition I just gave you, that's enough for them to believe that these individuals have enough financial sophistication and savvy to be able to evaluate your deal and make their own decision. So therefore, you know, it's sort of a safeguard, I guess, that's in place now to prevent people from going out and selling deals to individuals who simply cannot evaluate them. But remember, if you sell equity in your company, which is basically an ownership position in your company, these individuals now are co-owners with you of your venture. And depending upon how much equity you sell, they can acquire different levels of power in the decision-making structure of your company. So you have to kind of manage that. And of course, the courses that we have at the Startup Path go into a lot more detail about how to manage your equity financing over time to make sure that you maintain enough control. One of the reasons you go into business for yourself is so you don't have anybody to answer to, right? So you don't want to sell so much stock that now you've got a bunch of owners that basically have become your bosses. Just as a matter of information, all private equity financing in the United States is done under what's called Regulation D. And Reg D offerings are very common. If you go to an attorney that works with small businesses and say, hey, I'd like to organize a Reg D offering in the amount of, you know, $1 million, $2 million, whatever it might be, they'll know exactly what you're talking about. They'll have all the paperwork, and you can really minimize your out-of-pocket expenses to get that done. So almost all of the private equity offerings in the United States are done under what's called SEC Regulation D, and of course that requires that you have the PPM and that you work only with qualified or accredited investors. So the cost of equity financing is just the degree to which your dilution occurs, and that's a function of your valuation. So here's a couple of terms that you really want to try to get your arms around. The first term is called pre-money valuation, and that's the value of your company right now, the moment of a funding event. Okay, so let's just say that your company is worth $750,000. Now, don't ask me how we came up with that number. There's a lot of different ways to come up with that number, and our courses at the Startup Path talk a lot about how to do that. But let's just say, for the sake of arguments so that we can move forward in this webinar, that we've determined through our various different means that in fact your pre-money valuation is $750,000. Okay? So you are the sole owner of the company. That means you own 100% of a $750,000 value company. Now let's say you want to raise $250,000. So on the and you're successful. So on the day that that transaction closes, right? Now listen very carefully here. The moment that that transaction closes, that $250,000 flows into your company, which previously had a value of $750,000. Well, now it's got a higher value because $250,000 has just come in. In fact, the post-money valuation of the company is $1 million, or $750,000 plus $250,000, right? And then it's pretty easy to figure out what kind of dilution has occurred the investors have purchased 25% of your company. $250,000 invested in a post-money valuation of $1 million means that they own 25% of the company. Now, if that's a bunch of investors, right, that 25% is allocated depending on how much money they put in. But if it's a single investor, that single investor now owns 25% of your company, and you are down to a 75% ownership position. I hope that's really clear. And that's basically how you begin to manage your equity position in the company and your power position so that you don't give away too much ownership. If I had tried to raise $750,000, right, on a $750,000 pre-money valuation, I would now be only a 50% owner, and basically I'd be 50-50 partners with my new investors. So let's just talk a little bit about angel investors. You know, where are they? Who are they? Where do you find them? It's not that hard. You know, angel investors really is anybody that has high net worth. So they hang out, you know, at golf clubs and Broadmoor here in Colorado Springs, and you know, fine restaurants and hotels all over the world. But you can't just walk up to somebody, you know, in a hotel and hand them your business plan and say, hey, could you want to invest? That typically doesn't work. But what happens is these people tend to share deals with each other. So there's this sort of this informal network that angel investors are involved in, and they just hear about deals, and they give deals to one another, and they know what kind of deals each other likes to invest in. So here's where sort of that conundrum that a lot of entrepreneurs feel about, well, gee, should I tell people about my deal or should I keep it quiet? You know, tell people, because you need people to know about it who might be able to refer you to one of these high net worth individuals that might be able to invest. So, you know, again, when you're looking at angel investors, you want to get referrals to people that really have some expertise. Money is great, and you need money. Okay, that's great. And I've had a couple of investors over the years that have just put money in and haven't added any value whatsoever. But you know, if you're only going to raise a little bit of money and you're only going to get 3 or 4 people that are going to probably step up and invest, you really want to have some more value add than just the capital. Typically, the way an angel investor will work is they will take a look at your deal. If they like it, they will indicate that they are interested to you, and if they're really interested, I mean, not just telling you something because they want you to go away without any kind of conflict between you. If they're really interested, they will then probably have an accountant or an attorney or something that's part of their network of professional associates that will perform a little bit of due diligence on your deal. And that means they will scrub your numbers. They will perhaps even do a site visit. They could even go so far as to talk to some of your top clients to see how it is that you're performing. And so you can expect some of that perhaps. A real good sophisticated investor that is thinking about making a substantial investment will perform more extensive due diligence. Somebody just putting in maybe $25,000 or something and their net worth is $10 million, they're probably not going to go that far. Angels often work in groups as well, and you need to know that. So they're not that hard to find. So for example, my group in Arizona was called the Arizona Technology Investor Forum. That group still exists. If you happen to be one of our listeners from Arizona, don't hesitate to look them up. They're in the Tempe area. They go by ATIF as a short, but you should be able to find them if you do a quick Google search. Another good place to find, wherever you are in the United States, a website is called GUST, GUST.com. It used to be called AngelSoft, and this will probably give you the list of all of the major angel groups in the United States. And so you can find one that's close to you. Typically they have an application process where you have to submit your business plan and some other fundamental information. They will go through screening, and then if you are selected to present, you will present to all the angels. My group in Arizona, we were able to work very, very quickly. We had one deal, for example, where we invested $600,000 in less than 24 hours in a company called Flypaper. You can look them up, flypaper.com. Venture capital, I'll talk just a little bit about that because most of us are not at this stage. It's very difficult to get VCs interested in your deal. they will, I say usually wait, but they'll almost always wait until a venture is flowing revenue or has a high rate of signing these registered users. So you see companies like Facebook, for example. They're flowing revenue, but they're not, not even close to profit break even. But they have a lot of registered users, and VCs are very interested in those kinds of numbers. So if you are registering 100,000 people a month or something on a site, and they're coming back, and they're, it's all free, but they just keep coming back. They love your stuff. Somebody will figure out how to monetize that, and you can actually get investors interested, even though you haven't made a dime. But most VCs will specialize. So you want to review the website and get a sense of what they're specializing in. You can do that by looking at their portfolio. Most VC websites will have a link, a tab near the top, and it'll say portfolio companies or something like that. Those are the companies they've actually invested in. And what you need to do is look at those companies and see whether or not they're close enough to your industry to warrant your efforts to try to attract these VCs' interest. And many of them will have a website and a web interface that allow you to dump in a business plan and maybe some other information. Those kinds of cold calls, to me, are just simply not going to work. Much better to get a referral. Even then, it's almost impossible to get a VC to invest in your deal. But depending on where you are, if you've got some referrals, if you've got a good deal, don't hesitate to think about this as a source of potential equity capital. There are some new VC models. One is called Techstars. They're based in Boulder, Colorado. You should look them up. They have a completely new approach to investing. What they do is they put a very small amount of money into a lot of deals. They do, however, require that these deals attend a boot camp where they go through, I think it's a 3-week process of scrubbing the deal, getting the business plan, getting the value proposition, the pitch, and everything all lined up right. And then they bring in all their investor friends, and they have what's called a funding day. And you either get funded or you get booted out. The boot camp may be 3 months rather than 3 weeks. I forget. But Techstars has that model. And most states now in the United States have a Techstars-like VC investing firm that will put in very low amounts, but they typically require that you go to their boot camp and live with those other entrepreneurs that they're investing in through that boot camp. And then even then, you're not sure you're going to get the follow-on financing. Let's just talk quick about debt financing. Debt financing is provided by an institutional lender, or you can always do some debt financing from friends and family as well. A lot of people think that loans are only available through institutions, but most of the loans in the United States are made, from one individual to another. If you go that route, if you go and get a loan rather than an equity investment from friends and family, my recommendation to you is that you put the documents in place. It's easy to lose the love and affection of a family member if they think that somehow or other they were hoodwinked or not clear about what it is exactly that the terms of the investment were. So, if you're going to do a family investment, typically it's going to be a lot friendlier terms than you're going to get from an institution. You can go for lower interest rates. You can go for some deferred payments, maybe a year or two of making no payments on a loan until you are flowing enough cash to pay it back with some interest. If you go to an institution, they're always going to want some collateral. If they want a security interest in that collateral, that means that they want something put up against the loan, and it can be property, it can be real property, it can be some of your even some of your personal assets can be pledged in order to get a business loan, and that would be the personal guarantee. So you have to figure out what's right for you. Your rate of interest that you're going to pay is different from established companies. Established companies that are flowing capital, the banks can see, oh, okay, I can see their historical financial situation. They got good cash flow. They'll be able to pay this loan back plus interest. Startup ventures are going to pay more. You're going to pay prime plus. And depending upon the environment and the type of bank you talk to, it could be a fairly difficult kind of interest rate for you. But shop around, and community banks are better for local ventures that are working primarily within the community and providing the products and services locally. And the bigger banks are better for those types of companies that have more of a national, international product distribution strategy in mind, because they're going to be able to grow with you. Small banks understand what your situation is. They're sort of community oriented, and they might work with you. And just keep working at it. I mean, I've been to thousands of banks over my lifetime, and they're all different, and you have to get to know these folks before you need them. If you go to a banker when you need them, they're not going to be there for you. They're always there when you don't need them. So you want to start developing your relationships way in advance. You want to know what the term of the loan is, right? And these are just probably familiar terms to most of you, but what I'm going to point out is that most loans come with what is called restrictive covenants. And so make sure when you're getting a business loan that you understand what those covenants are, because there are both positive covenants and negative covenants. Positive covenants, these are performance targets that you must attain, and you've got to report to the bank that you are hitting your performance targets. Or the negative covenants say this is what you are to avoid. You can't have this type of a debt-to-equity ratio or something like that. And the interesting thing about covenants that you simply need to know is that many banks will say if you run afoul of any one of these covenants, we can call all or part of the note immediately. So, oh God, you had a bad quarter, and things just didn't turn out right, and you report to the bank, yeah, we missed our covenant, by a little bit, and the loan officer is nervous and scared and not sure your industry is going to survive, says, well, that's nice for you, but guess what, we're going to call the note. And now you have nothing, right, to use in the way of cash, and no recourse because you signed the loan agreement. So revolving loan is really nice to have. It's called a line of credit. And this is when you have cash flow fluctuations in your business. That's nice to have a line of credit. And simply what this means is that the bank will make an amount of money available to you without having to go through the process of filling out all the loan paperwork each time, right? So you go in there and there's this, let's say there's a line of credit of $200,000. You can draw that down incrementally or all at once and use that money, and you don't have to fill out a loan agreement. Of course, you have to replenish that money now, and the bank will charge you just for the luxury of having some money sort of set aside, even though of course that's not the case, but they will charge you a fee, a monthly fee, to have a line of credit set aside for you. It's usually not too difficult and fairly nominal, and you have to pay back the amount withdrawn with interest, of course, to make your line of credit whole on a regular basis. So work with the various bankers in your community to see which ones are going to provide you with the best terms. And sometimes you're going to have to shop around quite a bit. My advice to anybody is find somebody that specializes in your industry. If you're in the construction industry, look for banks that understand that industry. If you're in have laundromat, go to banks that understand people that are in the consumer services businesses, and they know that there's different types of challenges for these different types of businesses, and they'll be able to help you figure out what's the best way. So so the sources of capital are debt is individuals and banks, and then these small business administration loans. SBA loans are okay. They usually come with pretty heavy covenants, not only from the bank but also from the federal government. The only thing interesting about an SBA loan is that they are originated by the banks in your community. So you have to find some bank that actually does do small business administration loans. And the reason that they're maybe a little bit more motivated to provide you with capital under this type of an arrangement is that the federal government provides a guarantee up to about 75–80% of the loan in the case of your default. So look those up and take a look at what's available. If you happen to be a minority or a female or a veteran or something like that, oftentimes the federal government has some programs that they're promoting that will sort of accelerate the process of being able to get some of these types of loans. These are the tools you need to raise money. You need a business plan, and you don't need anything big, you don't need anything extensive. It has to be clear. Your business plan has to be clear, and it has to be clear according to the following terms. It has to be clear in your value proposition. It has to be clear in your market. It has to be clear in the ability of your management team to execute. That means you should list on there individuals who either have done this type of business before or who clearly have the educational background or some type of related experience that is going to help them execute. Your business plan has got to convey two things to me: excitement and confidence. Excitement and confidence. I have to be excited that you have a big market to pursue, and I have to be confident that you're the right group of people to do it. The executive summary, basically you write that last after your entire plan is done. I like to have a separate document. You want an executive summary stuffed into your business plan at the beginning, but you want a separate 2-page executive summary that you can hand to people that they can read really, really quickly. We already talked about your PPM. That's a private placement memorandum. You're going to need that. And also a subscription agreement. A subscription agreement typically is attached to the PPM, but oftentimes it's separate. I like to keep it separate. I like to get people to commit before I walk out of a room when I'm raising money. I like to get some type of a commitment. I like to look at my subscription agreements as non-binding, but they are psychologically binding. When I get somebody to sign an agreement that they're going to invest $50,000 in my deal, typically they close the deal. Only on one occasion have I had somebody that actually signed a subscription agreement and then later on backed out of the deal and did not go forward. Remember, every investor wants to know the WIFM question. What's in it for me? Your investors are no different than your customers. What's in it for me? If you can't answer that question, you don't belong in front of them at this moment. Here are some alternative financing options for people. The Small Business Innovation Research Program, or SBIR, is kind of shockingly unknown. Perhaps some of you have heard of this before. If you haven't, do look it up, because there is money available for different types of small businesses, and this is grant money. Now, this is like walking down the street and finding a bag full of money. Now, you got to write a grant proposal and everything, but there are no covenants. There are no loan officers asking you questions about how you're running your company. But it is a phased program. So typically it starts with about $150,000. And if you deliver the goods on what you said you're going to deliver with the $150,000, then a lot more money is available potentially on phase 2 and phase 3 of the SBIR program. So you want to definitely look into this. It is a federal government financing grant program. So we've had equity, debts, and now grant financing. Quite different. Another program very similar to the SBIR is called the STTR program. Less extensive in scope, has a little bit different twist to it. More businesses fit under the SBIR umbrella than STTR, but again, it's a grant option available from the federal government. There are municipal and state grants that you can pursue. There are a lot of foundations that are offering grants to entrepreneurs in various social entrepreneurship and other categories. Bootstrap financing simply means we're going to grow by internal revenue generated. We're never going to go out and try to raise equity capital. We're not going to dilute our ownership, and we're just going to try to go. The latest thing that's come up, and this is really only in the last year or so, is something called crowdsourcing. And there are a bunch of websites out there, including this one right here called Kickstarter.com, where you can literally go online, upload your business plan, and I think it's free, I'm not sure, and people can invest small amounts of money because they like your deal. So do check these out. It's called crowdsourcing. I don't know what the SEC is going to say about this in the long run, but they have looked into it, and so far they're letting it go. And to me, it's potentially dangerous because you're not looking for accredited investors. My guess is, all kinds of people are investing on these things, but nonetheless, it's a new form of financing. I think it's a bit of a crapshoot because there's a million people that are posting their business plans, as you can imagine, and hoping. But, there it is. Here's a bunch of web resources that you can look at that we have on these slides. The Angel Capital Association has a list of all the angel groups. Here's my group that I formed in Arizona, atif-az.org. This is the National Venture Capital Organization, Securities and Exchange Commission, Red Herring used to be a magazine. Now they just have conferences. TechCrunch is great because you can look at, see who's getting financed. TechCrunch I look at almost every day. Wired VC is kind of interesting, and ownyourownventure.com is a site that provides you some other ideas about raising capital. So that basically concludes my presentation for today. I hope that this has been instructive to you. Do come back to the Startup Path and look at the various resources that we have available for you. I do think that some of the courses that we have go into a lot more detail about fundraising and will help you decide what is the best pathway for you to get the capital you need for your business. I'm going to turn the discussion back over to Sheena Pasco now. Thank you very much, everyone.
Thank you, Dr. Duening. It was great to get your expert advice on raising equity capital. I personally found the funding stages very intriguing. Now, Dr. Duening provided us with a lot of information in this short webinar. However, there are many additional details to raising capital that he just didn't have time to cover. Fortunately, we have a full lesson on capital available to you in Step 4 of the Startup Path. The lesson is titled Raising Capital. I would strongly urge you to register for Step 4 and learn more about raising capital. In fact, for joining this webinar today, the Startup Path is offering a 25% discount to Step 4 or any other item that you wish to purchase at the Startup Path. Write down this coupon code at the top of your screen, use it when you check out, and get started today. This discount is being offered only to the first 100 people who decide to take that first step towards success in running their own company. Of course, the Startup Path offers 100% money-back guarantee if you are not satisfied with your purchase. We look forward to helping you reach your dreams through owning your own business. Please stay in touch. We are here to help you. You can also connect with us on Facebook, Twitter, and LinkedIn. And also look at our website and look for updates to Dr. Tom Duening's blog. You can see a blog tab at the very top of our website. So thank you for joining us this evening, and we hope to hear from you soon.